Hello and welcome to the UK Mortgage Market Insights for the weekend in the 24th of April 2026. I'm Craig, Director at Lodestone Mortgages, and this is your weekly roundup of everything happening in the mortgage market. The rates, the lenders, the economy, and what it all means for you. So if you find this useful, please do hit subscribe. It really does help the channel. Right, quite a week. Lots of lenders moving rates, some interesting economic data dropped, and I want to talk about something that's been flying a little bit under the radar, tracker mortgages. Who's really benefiting from them, and whether lenders are playing fair. Stick around for that one. Right, let's get into it. Well, it's been a busy week for rate reductions. NatWest, Skipton, the Mortgage Works, Nationwide, HSBC, Co-op, Principality, Santander, Halifax and Birmingham Midshires have all cut rates this week. That is a significant list. But the standout moves come from Barclays, Virgin Money and TSB. They didn't just cut purchase rates, they also cut remortgage rates by up to 0.6%. That's a meaningful reduction, and it matters for the millions of people sitting on their current deals wondering whether now is the time to act. Now, I want to talk to you about what's driving this, because I don't think it's quite the good news story it might appear on the surface. These rate cuts are not happening because lenders have suddenly become generous. They're not happening because there's peace in the Middle East, because there isn't. And as I'll come on to in a moment, swap rates are actually moving in the wrong direction this week. What's really happening is that when the Middle East crisis hit, lenders overshot on their margins. They got greedy. They priced mortgages so high that they effectively killed the market. Volumes fell and business dried up. Now they're desperately trying to win that business back. These cuts are about lenders correcting a mistake of their own making, not passing on genuine cost savings. And that's an important distinction. And this is where it gets uncomfortable because the data backs that up. Swap rates, which are the benchmark, as you all know, that lenders use to price fixed rate mortgages, have gone up this week, not down. The 2-year swap rate closed yesterday at 4.127. Last Friday, it was 3.988. That is nearly 14 basis points higher in a single week. The 5-year swap rate closed at 4.152, and last Friday it was 4.013. Again, almost 14 basis points up in a week. Green on a chart normally means good news. As you can see though, not here. When swap rates go up, lenders' funding costs go up, and that tends to feed through to mortgage rates eventually. The fact that lenders are cutting rates at the same time as swaps are rising tells you they're absorbing that cost themselves, at least for now. The question is how long they can or will keep doing that. And this is why I keep saying, if you're in a position to act, do not wait. Windows like this don't stay open indefinitely. Now, this week has genuinely been all about rate movements rather than criteria changes, so there's nothing major to flag on that front. The story this week is pricing, and I've covered that already. So watch this space on criteria. I expect we'll see some movement in the coming weeks as lenders look for other ways to compete for business. Now, I want to spend a moment on something that I commented on in the press this week, because I think it deserves more attention. Tracker mortgages have been growing in popularity, and on the face of it, that makes sense. Right now, they are cheaper than 2-year fixed rates. In a market where affordability is stretched, cheaper monthly payments are an obvious appeal. But here's what a lot of people aren't seeing clearly. Tracker mortgages are priced against SONIA, the Sterling Overnight Index Average, which moves almost in line with the Bank of England base rate. Lenders don't have the same swap rate exposure on trackers that they have on fixed rate products. They're not buying long-term funding at these elevated swap rates. So you'd think they might price trackers attractively to reflect that lower cost. Well, what they've actually done is quietly widen their margins on tracker products. So while the headline rate looks appealing compared to a fixed deal, the lender is making more money per tracker mortgage than they were before. The customer thinks they're getting a bargain. The lender is doing very nicely. Thank you very much. Now, is that profiteering, or is it prudent pricing to account for the risk of customers leaving early if rates fall? I have a view on that, but more importantly, I'd like to know what you think. Please drop in the comments. Do you think it's profiteering or fair pricing for risk? Let's have that debate. And a word of caution on trackers generally. Yes, they're cheaper now, but they move with the base rate, up and down. If you're the kind of person who needs certainty in your monthly budget, a tracker is not for you. Get proper advice before you go near one. Right, I want to touch on something this week that is not strictly a mortgage story, but it absolutely affects the property market. And if you've got any buy-to-let properties in your life, whether that's one property or 10, you need to know about this. The Renters' Right Act becomes live on the 1st of May. Well, most of the changes do anyway, and that's next week. And it's one of the biggest shake-ups to the private rental sector that we have seen in a very long time. So what does it actually mean? Let me run through the main points. First, and this is the big one, Section 21 is gone. No-fault evictions are abolished from next week. As a landlord, you can no longer ask a tenant to leave simply because you want your property back. You now need a legal reason. Selling the property, moving a family member in, serious rent arrears, antisocial behaviour, those grounds still exist, but the old get-out clause, that's gone. At the same time, fixed-term tenancies are also going away. All tenancies, new and existing, automatically become rolling monthly agreements. Tenants get more security, which is the main point, but it also means landlords lose that fixed end date that they used to rely on for planning maintenance or remarketing, whatever it might be. On rents, landlords can only increase once every 12 months, with 2 months' notice, and the tenants now have the right to challenge that increase at a tribunal. There is also a ban on rental bidding wars, so you can't accept offers above your advertised price, and upfront rent is capped at 1 month. No more asking for 3 or 6 months in advance. There are also new rules around discrimination. Landlords can no longer refuse applicants simply because they have children or because they are on benefits, and tenants now have a legal right to request a pet, which you cannot unreasonably turn down. Fines for getting this wrong can reach £40,000, so this is not something to take lightly. Now, what does all this mean for the market? Well, there are a few things worth thinking about here. Some landlords, particularly smaller ones, or those who were already on the fence about staying in the game, they're likely to use this as the moment they sell up. And if that happens at any scale, it adds more stock to the sales market, which is actually a modest positive for buyers. The flip side is that if rental supply drops, rents go up, which is a bit ironic given that this legislation is partly designed to make renting more affordable. Now, whether that plays out depends a lot on how many landlords actually exit versus how many simply adapt. For professional landlords who already run things properly, the honest truth is that the day-to-day change is probably less dramatic than the headlines make it sound. The bigger concern is what happens when a tenancy goes wrong and the legal route to getting your property back becomes slow and expensive. If you've got a buy-to-let mortgage and you're wondering how this affects your situation, whether that's around your remortgage plans, your rental yield calculations, or whether it's even worth holding on to, then get in touch. We can look at the numbers with you and help you think it through. Right, let's look at the wider picture because there was a lot of economic data out this week and it paints a fairly clear picture of where we are. Inflation. CPI rose to 3.3% in March, up from 3% in February, and that's moving in the wrong direction. Services inflation, which the Bank of England watches very closely because it reflects domestic price pressures, ticked up to 4.5% from 4.3%. When services inflation is rising, the bank gets uncomfortable, and so it should. Jobs? Unemployment is at 4.9% for the December to February period, which is up compared to a year ago. Payrolled employees fell by 74,000 over the year to February. Wage growth, regular pay, is running at 3.6% annually. That sounds reasonable until you factor in inflation, and in real terms, workers are barely keeping their heads above water. House prices, the ONS and Land Registry data to February shows average prices up 1.2% annually at 268,000, but London is a different story. Prices there are down 3.3% on the year. So for anyone watching from the capital, that is a significant shift, and it reflects just how hard the combination of higher mortgage rates and stretched affordability has hit the London market specifically. Now, there has been a huge amount of data this week, so what does all of this tell us? Well, it tells us the economy is under real pressure. Inflation's rising, jobs are softening, and real wages are barely growing. That is normally a combination that will lead the Bank of England towards cutting rates. But here's the problem. The Middle East conflict is keeping energy prices elevated, and that is feeding directly back into inflation. The bank is caught between a weakening economy that needs lower rates and an inflation picture that won't let them cut. Now, I've been saying for weeks that I don't think the bank will cut rates at next week's MPC meeting, and I don't think that they'll hike them either. It's going to be a hold at 3.75%. The data we've seen this week does nothing to change that view. The governor has already signalled that rate rises are not the answer here, something that we've been saying for quite some time now, because the economy is too fragile for that. But the inflation environment makes cuts very difficult to justify. Hold is the only sensible call. So what does all of this actually mean if you're looking at a mortgage right now? If you're on a fixed rate that's coming to an end in the next 6 months, just get on the phone to a broker or come and talk to us. You need to get a rate secured now. Most lenders will hold an offer for 3 to 6 months, more likely 6, And if rates improve before you complete, we can go back and reprice. There is very little downside to acting and a real downside to waiting. If you're thinking about a tracker, please do not make that decision based upon headline rate alone. Get proper advice. Understand what your payments would look like if the base rate moves, and make sure if it fits your circumstances, not just your short-term budget. And if you're a first-time buyer, this market has pockets of genuine opportunity. Sellers in London are particularly having to negotiate. The lenders competing for your business right now means there are some decent deals to be had, and a good broker will help you find them. Now, my overall read this week is this. Lenders are cutting rates, and yes, that's welcome, but don't confuse it for a fundamental shift in the market. They overplayed their hand on margins, and now they're correcting it. Swap rates moving up tells me the underlying cost environment hasn't improved. The inflation data tells me the Bank of England isn't going anywhere fast on rates, and the jobs data tells me the economy is quietly getting softer. The window where lenders are cutting despite rising swap costs is the opportunity. It won't be permanent, so if you can move, move now. That's your weekly UK mortgage market roundup. A lot to digest this week. Lender rate cuts across the board, rising swap rates, a really interesting tracker mortgage debate that I'd love your thoughts on, and some pretty significant economic data. If this has been useful, please do subscribe and share it with anyone that you think might benefit. I'll be back next week with more, so I'll see you then. Take care.